All right, and we are live, so hopefully we get all of the recording this time. All right, so on the negotiations, so there were some of the parts that you sent us that we are good with. So the voting rights for Series A, if converted to common stock, will definitely give you that. The anti-dilution protection, the pro rata rights to participate in future financing, and then the linear vesting of employee options over 48 months after the 12-month cliff will give you that as well.
Okay.
And then consent of major preferred shares required for dividends, preferred common purchase, loans, all of that. So that provision will give you as well.
Okay.
So let's start with the actual amount of offer. So we're looking for about 2.5 million.
Okay.
And we're looking at, so for the 30% share, we're looking at $2.5 million.
And then I'd have 30% stake.
Yes.
All right. I would agree to that. Or would you guys go as low as 2.2 or 2.3 million? Or are you?
We could do 2.3 million.
Yeah. Okay.
All right. So that one is good then. And the post money valuation, you have it at 4 million. And we were looking at a post money valuation of around 7 million.
Yeah, hold on. I'm just looking at this.
Yeah.
I'm ready, Grandma. Where's your stuff, Andrew? Come on, I'm gonna get cold. These are her clothes.
You said, what did you say? How much?
So we're looking at about a 7 million post money valuation.
Okay. Yeah, I would give you that.
Okay.
And we will give you the option pool at 15% as well. So that was what we were thinking on that. So we're right on track for the option pool. And that is fully diluted at the time of closing.
Okay.
So the next big thing, the next big concession we were looking at was on the makeup of the board of directors.
Okay.
So we're looking for Maxwell as well as Taylor, since she is the actual founder of the company. So we would like to have the CEO and the founder, Taylor, on the board of directors. So that would be a 4-person board with one person from DuPage and then one independent director as well.
Could we negotiate to where Taylor isn't a director on the board, but instead we consult with her before we make decisions? Like getting her input without making her a director?
Because I think she needs to have say in what the company does going forward, since it is her company and it is her idea, and she is the founder. So I think she needs to really have say in what the direction of the company is, and without having any decision rights, the company could go a different direction than what she's wanting it to go.
Yeah. DuPage just feels like bigger boards slow down decision process making, and so we have we would like a 3 board, 3 members on the board. And so that way it makes the most sense to have your CEO as one of the board members instead of the inventor, coming from your company with the 3. But we could still consult Taylor's decisions and everything without making her an actual director.
I know I've been gone. Andrew, do you know where the pinky is?
Okay, we can give you that. So as long as she's consulted in decision making, then we can go with that.
Okay.
And then that one we are good at.
What did you take, Teresa?
Oh, Teresa, that headband is too tight. That's like, hasn't fit her lately. Yeah, leaves a bad indention in red march.
So, and the other thing that we kind of have a concern with is DuPage wanting to change the CEO. So in the future, I can see if she's if the company's outgrown her capabilities, outgrown Maxwell's capabilities, then I could see the possibility of looking at changing CEOs then. But that's something we would have to talk about. I don't know that I would be okay with right away changing the CEO and having the right to change it whenever, just because. It has to be that she is incapable of running the company anymore.
Yeah, we like her as a CEO, but we just, I was concerned that if we needed to switch a CEO and she was too comfortable in her position and unwilling to do that. But yeah, I would agree to that as long as there are signs that she isn't capable of the direction where the company needs to go.
Yeah, and she does understand that that at some point it may be outside of her capabilities to continue running the company as the CEO, but she would like to run it until it gets to the point where it's beyond her capabilities.
Okay. Yeah, that's fine as long as, when that comes, she would be willing to switch.
All right, so it looks like the last 2 we have are the dividend and the founder shares. So can you come down any on your dividend?
Hold on. The furthest I could come down on the dividend would be to 8%.
8%.
Could you come down to 7?
No, I think 8's the low. Well, yeah, 8's the lowest that DuPage kind of does with all of their investments. They have a limited to the 8% as the lowest.
Okay, we can do 8%.
Okay.
All right, so the last one would be the founder shares vesting. So we would like to see 35% vesting on closing, and then the balance vested over 24 months.
She looked at her mom and dad, smiled and laughed, looked at me like she's intrigued.
You said 35 over.
So 35, so the founder common shares vest 35% on closing, with the balance vesting linear over 24 months.
Could we compromise to 30%?
Yeah, I think we can do that.
Okay.
So founder shares vest at 30% and then the remainder over the next 24 months.
What was that? Say that one more time.
Okay, so 30% of shares vest on closing and then the rest vest linear over 24 months.
Could we compromise on 30 months?
Are you good with that, Paulette?
Yeah, I'm good. Yeah. Are you?
Okay. Yeah, I think we can do that.
We can do that.
Okay.
Yeah.
Here, I got it, Mom.
All right. So I think we're good. I think we can go with that. And one thing that you didn't know this whole time, that I guess we'll now tell you, is we had 2 other offers on the table. And
Oh,
so what we were going off of, a lot of those stipulations that we had were things that we had already gotten from one of the
wow.
other offers. And so that's why we were able to know specifically what we wanted, because we did have other offers on the table that kind of gave us a base of where to go from.
Okay. Yeah, what my sheet was said, like, it gave me provisions that they do with every one, like that 8% was on on all of them. So I started at 10% so that we'd have a little bit of wiggle room. But Jonathan Cantor with DuPage was limited to how much he could invest on this, since he is not as experienced at the firm.
Okay.
But I could have gone up to $3 million.
Yeah, and we were
So.
one of the offers we got was for 2.5, and one was for 3 million. But we were looking at more 2.5 million, just because of the 2.5 million would basically cover our growth, and make it. But I mean, going just under would still serve us just fine. So the 2.3, I think, will work out just fine.
Yeah, that should be okay. And then, like DuPage was willing, if this round goes well, they were willing to invest, in the next round.
Yeah, and we're happy with that provision as well. And then our sheet, I think it basically said that the other offers were at 8% annual dividend. So settling at 8 was right where the other offers were at as well.
Yeah.
Cool.
And then all of your other, like the pro rata, in future financing, linear vesting, all of that was basically the same as what the other offers were. So I think we're right on track, and we've got what we were wanting out of this. So
yeah, I think I got what I wanted too. The only thing that I didn't was the 35% on that month, because that provision that was one of the things that's just kind of set for most of their ventures that they invest in. But yeah, I changed that one a little bit. But yeah, for some reason they don't like the founder. And so they didn't want her as a director. That they were pretty
okay.
On that, but they like the CEO a lot, but they just they wanted that freedom to switch the CEO in case if she needs to.
Yeah, I'm good with all of that. And we were willing to go up to 35% on the ownership. But we're happy with 30% too. So
yeah, mine said
where he drops you off or picks you up.
hold on, let me find it.
well, actually, the other one that we were looking at was Prosper Fund, and their offer was actually at 40% ownership, which we thought was too high. And we actually that was actually the best offer, I felt like, because they are a better company. The 2 companies that we had, one was basically was struggling to even make the money back. And they were struggling to get any more investors because their returns were just not where they needed to be. And that one, they were willing to give us 2.5 million at 25% and value the company post money at $10 million. But I felt like they weren't as strong of a company or as good of a company. Prosper Fund was willing to do $3 million at 40%. So it's just really interesting. This is kind of a cool process.
Yeah, and I could. It said that DuPage preferred to own between 20 to 30%. So I could have gone down to as low as 20, but we like that 30%.
Yeah, and I'm good with 30% compared to the other offers we had. That's right smack in the middle, and I think DuPage a much better company to work with than the other two VC firms.
Companies.
Yeah.
Sure. Yeah, I thought it's kind of a fun process.
Yeah, the only thing that we were wanting that we didn't really get was Taylor as a member of the board, which Prosper Fund was willing to give us, but they were
Okay.
also wanting 40% to be able to do that.
Yeah.
Yeah, and like obviously we didn't want her a member of the board, but she still will be consulted in decisions, so it's not the worst thing.
Yeah,
Okay.
yeah, I think it works well for everybody.
Okay.
So let's look at what the actual questions were that we're supposed to ask after we do that. So let me pull the case discussion.
The chat book's free, Mom.
Okay, so I think we've already covered 3. We reviewed the data and talked about what happened that led us to making those decisions. Okay, so and I think we've already kind of covered question 4. So it said from the DuPage side, what were your goals for this negotiation? What was the value that you were hoping for?
Yeah, we kind of went over all that, but I couldn't go higher than 3 million is the biggest provision that they gave me. And then the
And what
20
was
Go
what
ahead.
was the post money valuation that you were like kind of given to work within?
Let me post it up. I'm trying to find it. $7 million.
Okay,
Is that
so
what we settled on?
that's what we settled on.
Mm-hmm.
Okay.
Yeah, and that was actually the lowest post money valuation of the offers. The other one was 7.5 million. But again, they wanted 40% ownership for that 7.5 million. So
Yeah.
okay, so and what was your internal rate of return that you had to achieve?
It actually didn't give me one.
Okay.
What about you guys?
So it didn't have one for us either. So
Okay.
so on the so we already talked about the board seat. So how important was this deal for DuPage? Was it like a good deal? Was it a once in a lifetime deal, or is it one that they were really considering passing on?
It was like Cantor that's kind of in charge of it. He's a newer guy at the firm, and so excited about this, but the people above him gave him so many provisions because they thought that like gave him a little bit of money to kind of play around with to try to prove himself a little bit, but it wasn't vital for him. Yeah, if that makes sense.
Yeah.
Yeah. And does
So
MuMate fit the investment focus of the company?
yeah, it fits a healthy lifestyle brand, which is which is what they're trying to adopt and what Cantor specifically was really excited about. So yeah, it fits what they're looking into, like evolving into, if that makes sense.
Yeah. All right. So the questions it's asking for our side is, did the co-founders see things the same way, or were they focused on different interests? So really, Taylor's big focus and the thing she was most worried about is that they would is that the brand would be pushed to kind of dilute the brand, so to speak. So that her biggest worry was that by going with a venture capital firm, they would want to cut costs by going with cheaper source products, which would hurt the brand because of they source the products as the best products available to create the drink. And so her worry was that they would go with cheaper, less quality ingredients in an effort to cut cost. And so that was her biggest worry. And so that's why she wanted to be on the board to make sure that that didn't happen. But I think the CEO as well also has some to say in that. But Maxwell's focus was more on the growth of the company and getting a deal with the distribution companies.
Yes, I agree.
Okay, so how did you go about valuing MuMate?
This is for all of us now.
So it says, how did the venture capitalists go about? So this would be a DuPage question.
Hold on, let me go to that.
So, I mean, I guess really this could be any of us. So it's so what exit value are you expecting? And from that, how much did they need to receive in order to get 5 to 10 times their investment? So I know it talked about in the case study that they needed to at least reach $50 million in sales by 2015, and based on the data and the sheets that were provided in the case study, the forecast was that they would hit $50 million within the time period. The worry was whether they were 100% correct, which there's not enough historical data to really determine what the future growth is going to be, because it's just been small stuff. They haven't gone full scale until this point. And so they're trying to go full scale and trying to get bigger and tap into the recent publicity that they've gotten from celebrities. And so because of that, it's hard to determine what the future of the company is going to be based on past results.
Yeah.
Yeah, and it calculated in my thing the 2015 like exit was like 20.4 million. Is that what we're looking at?
Yeah.
Mm-hmm.
So is that what you guys would have gotten out of it at that point then?
Yeah, yeah, I think they would have gotten it if they exited at 2015, to my understanding.
Yeah, so I mean, that is a pretty good rate of return.
Yeah.
So, so let's talk about bargaining tactics. What have you learned about some of the bargaining tactics from this case?
Well, in my case, start lower than what you're expecting to, like give room for negotiation, and where you'll still be happy with it. Yeah.
Yeah, so we started lower than what we were wanting to end, or in your case, in some of them you started higher. That way you had room to come down.
Yeah, exactly.
And I think one of the other really big tactics that we took was we really analyzed everything. We had a discussion and we talked about what were the most important things to us. And then figuring out which things we weren't willing to change on and what things we were. That way we knew going into negotiations, we'll give these concessions. We're more willing to budge on these things than we are on these other things. That way, when it comes down to it, we can give concessions that aren't as important to us and get those things that are the most important. So understanding what your goals are and what's the most important moving forward.
Yeah.
Yeah.
Yeah, that's good. I didn't have any feedback from Kip, and so I
Yeah.
don't know what he was thinking as far as everything went, but yeah, I kind of, when I read the case, I kind of tried to pick out what, was the strictest provisions and stuff that I had to follow and the most important to do page.
Yeah.
So
Right.
the same.
So do you think hardball tactics make sense in a negotiation like this?
No, it's not.
So I think, from my opinion, it didn't really seem like we needed to, because we were both able to get basically what we wanted. The only time you played hardball was with Taylor saying, look, I can't give you that, but
Yeah.
this is what I'm willing to do. And I think when it comes down to, if that was one of the most important provisions within your, that was important to you, and to DePage, then I think in those moments, that's where it becomes the most important to play hardball, is to make sure you get those things. So, but I feel like overall, we didn't really have to do that because we had room for moving to get what we both wanted.
Yeah, I agree. And when I read that in my case, I was kind of surprised that, because I don't know if I, agree with it. Like, it makes sense to have the founder on the director of boards. So
Yeah.
it's kind of sad that they don't want her to be, but she still has, say. So
Yeah.
I was
Yeah.
just
And
kind of
then,
surprised that was one of the things that I needed to follow.
yeah, that is interesting. I think that's just to make this more interesting too.
Yeah.
Because if it hadn't been and you had just given in on that one, it would have been nothing. We would have just breezed right through this.
Yeah. We have to have some areas
So,
where we have to disagree.
yep. So, the question it asks, should we have disclosed that we had other offers on the table? And we talked to, both Paulette and I talked about this before you were able to get on. And we're like, well, how long do we hold on to that card, and do we play that card? And really, in this situation, it never came down to the fact that we needed to. We were able to work out everything, but it did give us a bargaining chip to say, hey, look, we've got other offers on the table. If you're not willing to give us this provision, then we can walk away, because we do have that provision with this other offer. And so, in this situation, we didn't really need it because we were able to work it out. But I think overall, it is something that we had that we could have used if we needed to.
Yeah, and I think, like, from your standpoint, that would be a useful card to have for those times where, like, you had to play hardball and get the certain provision or whatever,
Yeah. All right. All right. So what were your key takeaways from this? I know. I think just again for me, weighing like the pros and cons of the different provisions that I had and whether which ones like were negotiable or not, and then so like when you have the opportunity, weigh all the pros and cons for all the situations, and so that way you can analyze if they're on the board or whatever would be worth us not making a deal, or or if it would still be worth it, but then lower the valuation.
Right.
Yeah, and I think one of the things that I probably didn't do as well with this as I should have, but as I'm looking some of these questions, um, I'm realizing that probably with the analysis, I should have done more in-depth analysis on what the returns would be, and like we talked about a couple weeks ago, where what the rate of return needs to be, and what they would be expecting. And so calculating to say, hey, look, this is what your rate of return is going to be if you go with this number, and having that information available to throw out in a negotiation saying, look, you're going to meet this rate of return within your investment by investing this amount of money over this amount of time with this expected growth. So I think that that's something that I probably should have taken a better look at that I didn't. But I think overall, like we discussed previously, it's important to understand what it is you're looking for and to understand the valuation. So how is the company valued? And having other, for us, having other companies give us post-money valuations and other offers, we were able to really look at that and come up with a post-money valuation pretty easily, because we knew what other companies were already offering us and how they already valued the company. But I think having an understanding of how to value a company deal in this situation.
Yeah.
Yeah.
And I agree with you that it would have been helpful for me to have to like previously analyze the rate of return and everything for a bunch of different numbers so that I would know how much I was getting or losing by negotiating, you know?
Yeah.
So that would have been wise. What about you, Paulette?
Yeah, I agree. I think in these type of discussion or like cases or cases, I think it's really important to know the calculations of what or the numbers or percentages that you're going to be receiving or that you're going to be offered to. And that's actually one of the things I struggled with too, was getting to get the right or a good amount or a good idea of the calculations that would that MuMate would be receiving. So I also think and agree with both of you.
Yeah, and I think in a case like this, it's kind of hard because there's so much going on,
Yeah.
and it goes back to kind of what Brother Mitchell said. I don't remember, it was like week 3 or week 4, where he talked about all of the clutter that can get in the way and distract you from the actual facts that you know in a case. And I felt like that was kind of the way with this case is I kind of got distracted by other things and didn't maybe pay attention as much to some of the other things that I should have paid attention to. So that's also a very interesting thing to know, moving forward, to know that you do need to look at other stuff as well. Don't get too distracted by what's in front of you.
Yeah, and that was one of the main
That's a good
problems
point.
because we had other offers on the line, and so there were like a bunch of numbers in front of us, and we were trying to find out the best option for MuMate.
Yep.
Yeah, and that's a good point. And that's obviously, you know, with our case analysis that our instructor wants us to practice every week when we do those is differentiating what's important in the case versus what's just clutter.
Yep.
Yeah.
So it's a good opportunity to practice that.
Yeah.
All right, so I'm going to go ahead because I think discussing the takeaways pretty much does our summary. So I'll stop the broadcast.